U.S. orders complete blockade, China's big currency reversal, German Volkswagen shutdown. Things have just gotten crazy again. So what's going on with oil? And why is the U.S. military involved? If you've ever seen those skits or jokes about oil, with Black Hawk helicopters descending on oil-rich lands, you'll know exactly what I'm talking about. Well, President Trump seems to be bringing that stereotype to life. What just happened is nothing short of unbelievable. And it's all about turning up the pressure on Venezuelan President Maduro. And now the global oil market? It's becoming collateral damage. Here's what went down. Trump has ordered a complete blockade on all sanctioned oil tankers. That means no oil ships can leave or enter Venezuela's ports. The U.S. Navy has surrounded Venezuela, and it's only going to escalate from here. It's clear that Trump wants all the oil, land, and assets that Venezuela has taken from the United States. What exactly does that mean? We're still not sure. But what we do know is that Maduro's oil trade is about to be throttled big time. Just a week ago, Trump ordered the seizure of an oil tanker. A special forces operation grabbed 1 million barrels of oil. And that's already a huge deal. But this blockade? It's a whole new level. It's not just a strategic move, it's a clear warning to other global players, especially Iran and Russia, who've been using shadow fleets of sanctioned vessels to avoid international scrutiny. Right now, about 10 to 20% of these fleets are sanctioned, but that number could easily rise. If it does, the U.S. could seize these vessels using military force. And here's the kicker. With this blockade in place, the U.S. now has a reason to enforce control over global shipping lanes. That means the U.S. Navy could establish choke points anywhere in the world, disrupting global oil trade. And what does all of this mean for oil prices? They've already spiked by over 1%. Why? Because even though Venezuela exports less than 1 million barrels of oil per day, and the global market handles over 100 million barrels daily, this blockade is about much more than just Venezuelan oil. It's about sending a message. The question now is, could Trump extend this blockade to other countries and regimes? The global oil market is on edge because, while Venezuela's contribution is small, the ripple effects could be massive. If this blockade continues, Venezuela's oil revenue, which makes up over 20% of its GDP, will take a huge hit. That could destabilize the economy further, and the U.S. is banking on that. In fact, the pressure on Maduro is already showing. Buyers of Venezuelan crude are demanding big discounts. Why? Because they don't know if their shipments will even reach their destination. Will the oil be seized halfway through the journey? No one can say for sure, and that risk is pushing oil prices lower. For context, the discount on Venezuelan crude went from $14 to $21 per barrel after the last tanker seizure. That's a 30% discount. And it's not just a number. It's a serious financial hit for Venezuela. Why? Because shipping oil is now a risky business. Tankers could be intercepted, delayed, or even seized mid-transit. And that could result in something called a demurrage penalty, an extra fee for delayed shipments. This risk is pushing the pain back onto Venezuelan oil producers, further squeezing their already fragile economy. Now, let's bring China into the mix. China buys about 90% of Venezuela's oil exports. They're the lifeline for Venezuela. But the blockade is hitting China's supply chains, too. Why? Because those big discounts the U.S. is demanding could disrupt China's access to cheap oil. And given that China relies on this cheap oil for its manufacturing sector, any disruption could lead to serious problems in its export margins. But here's where things get even trickier. There's a massive amount of Venezuelan oil sitting around the globe, about 20 million barrels of it, stored on floating storage units. China has been buying up to 600,000 barrels of oil a day from Venezuela, and that stockpile should last until late January or February. After that, there could be a crunch. So why is this a big deal? Because Trump's blockade isn't just about Venezuela, it's a strategic message to other global players. It's a flex to countries like Iran, Russia, and even China, showing that the U.S. can control the flow of crude oil. And it's not just about being a major oil producer. It's about using military power to shape geopolitical outcomes, something we've seen before in what's called gunboat diplomacy. Meanwhile, China is responding to its own challenges, especially in the currency arena. The Chinese yuan is undervalued by about 25% according to Goldman Sachs. This is something China has been doing for years, keeping the yuan cheap to boost exports. But with Trump's tariffs, China has been able to weather the storm by keeping the yuan low, making its goods cheaper for the global market. One of the biggest factors driving the global economy right now is China's trade surplus, which is expected to hit $1.2 trillion this year. Along with this, there are discussions about China planning to appreciate its currency, the RMB, Chinese yuan, by 50% over the next 5 years. At first, that might seem unthinkable, but it's possible, and here's why. China's export challenges have been solved, and there's room for the currency to increase in value. Right now, compared to major currencies like the US dollar and the euro, the RMB is undervalued in real terms. This means that China could appreciate its currency, and that could last for quite a while. If this happens, two major effects could occur. 1. Foreign investment increases. As the RMB appreciates, China would attract more foreign investments. Why? When a currency becomes stronger, people who invest in that country see their returns grow, encouraging more money to flow into China. 2. Domestic consumption grows. With a stronger currency, Chinese consumers would feel richer. Imports would become cheaper, so Chinese people would spend more on both domestic and foreign products, which would also benefit the local economy. More spending leads to more growth, helping China's economy. However, this situation isn't great for the U.S. If China's currency appreciates, capital could flow out of the U.S. This means that investors might find Chinese stocks and bonds more attractive than those in the U.S. This could lead to less investment in the U.S. economy, and even a decline in the value of the dollar. President Trump has praised the U.S. economy, giving it a grade of A++++. But the truth is that the numbers don't match up with the optimistic view. For instance, in October, the U.S. recorded the largest drop in payrolls since 2020, the biggest drop since the pandemic. Additionally, unemployment has risen to 4.6%, the highest it's been since 2020. These statistics are making investors nervous about the U.S. economy's stability. This data also suggests that more rate cuts will be on the table by 2026. This could result in further weakening of the dollar, which would make Treasury bonds less attractive to investors. If China goes ahead with appreciating its currency, it would only add to the challenges Trump is already facing. The U.S. economy is highly financialized, meaning it relies heavily on financial markets. The AI bubble is growing, and the U.S. needs to keep money flowing into its financial system. If capital starts leaving the U.S., it could trigger a crisis. On the other side of the world, Germany is already facing a collapse. The problem is that Germany no longer has access to cheap Russian energy and raw materials. Without these affordable inputs, German industries are struggling. Volkswagen, one of Germany's largest companies, is shutting down its production in Dresden, marking the end of an 88-year history of manufacturing there. This is a huge blow for the company, and it's not the only problem they're facing. By 2030, Volkswagen is expected to cut over 30,000 jobs in Germany. Why is this happening? The answer lies in the energy and raw materials that Germany no longer has access to. When Europe cut ties with Russia and shut down its nuclear plants, it made it harder for companies like Volkswagen to compete globally. Even though Volkswagen has an investment budget of 160 billion euros, the company is unsure how to allocate these funds. The automotive industry is shifting towards electric vehicles, EVs. But Volkswagen is also dealing with a cash flow crisis because of weak sales in China. Chinese competition is fierce, and demand for their cars in Europe is weak. On top of that, a 20% tariff on exports to the U.S. is crushing their sales there. So trying to shift focus to the American market won't solve their problems. This situation has been building for years. The moment Europe sanctioned Russian energy and closed its nuclear plants, the writing was on the wall for German industries. Without affordable energy, Volkswagen's electric vehicle production will suffer. As a result, there will be fewer units produced, which leaves room for more affordable Chinese vehicles to take over the market. Despite tariffs, Chinese vehicles remain much cheaper. For example, a Chinese EV costs around $26,000, while a German-made EV is priced at about $64,000, more than double the price. Even with tariffs of 50% or 60%, Chinese cars are still much cheaper. The same thing applies to combustion engine vehicles. A Chinese gas car costs $26,000, while a German-made one costs around $47,000. Unless Europe decides to stop importing Chinese cars, which would create a diplomatic crisis, Chinese vehicles will continue to flood the market. The demand for Chinese cars in the EU has surged since 2025, especially after Trump's tariffs. European consumers simply don't have the money to spend on expensive cars. With groceries and energy prices rising, the choice between a $60,000 German car and a $40,000 Chinese car is easy for most consumers. Volkswagen may still be the top player for now, but over time, Chinese car brands will catch up. Europe has a few tough decisions to make. One option is to restart its nuclear plants or even build new ones to secure cheap energy. Another option is to make peace with Russia and bring back access to cheap gas. Until these options are considered, Germany and the EU could face a continued decline in industrial output. The competition in China's mainland market is incredibly intense. At the same time, demand for European cars is extremely weak. On top of that, the 20% tariff on cars exported to the US is hurting sales, making it clear that trying to shift sales to the US won't work for companies like Volkswagen. This situation was easy to predict when Europe decided to stop importing Russian energy and shut down nuclear plants. As a result, Volkswagen is now facing problems. Their Dresden plant has been shut down, which means the production of their ID.3 electric vehicle will decrease. Fewer units will be made, and this opens up the market for even more Chinese vehicles. Despite tariffs, Chinese cars are still just too affordable. A Chinese electric vehicle EV costs around $26,000, while a German-made EV costs around $64,000. That's more than double the price. Even if the tariff on Chinese cars is 50% or 60%, they're still much cheaper than German-made cars. The same price difference is true for traditional combustion engine cars as well. A Chinese gas car costs about $26,000, while a German-made one costs about $47,000, which is almost 90% more expensive. Unless Europe takes drastic measures to stop the import of Chinese cars, there will be a major diplomatic issue. Chinese cars will continue to flood the market, and the EU will face a growing problem. Since 2025, EU demand for Chinese vehicles has surged, especially after Trump's tariffs on foreign cars. Whether it's traditional gas vehicles or electric cars, the demand for Chinese cars in Europe is rising sharply. The reality is, European consumers simply don't have the money to spend on expensive cars. With the rising costs of groceries and energy, when given a choice between a German-made car costing $60,000 and a Chinese car priced at $40,000, the decision is clear for most buyers. Right now, Volkswagen is still holding a top position, but as time goes on, Chinese car brands will continue to catch up. Europe is facing some tough decisions, and both options will be difficult. The first option is to bring nuclear plants back online, or even build new ones, especially in Germany, to secure cheap energy. The second option is to make peace with Russia and restore access to cheap gas. Without these steps, Germany and the EU will continue down a path of deindustrialization. It's a dangerous cycle, and unless these decisions are made, it's only going to get worse. What do you think? Did Trump make a mistake with the oil blockade? Can Germany revive its auto sector without Russian energy? Let me know in the comments below. Stay safe, and don't forget to like and subscribe as we continue to navigate these challenging times.